Welcome to another episode of Capital Spotlight Podcast. Today we have Roded Leviathan. Welcome to the show.
Thank you, and thank you for having me, Rob. Good seeing you again.
It's good to see you again, and I'm excited to hear all the updates you have for us. So to start off, why don't you tell us about your background and give us an update on what you're doing today?
Sounds great. So, for the last half a decade or so, I've been working as director of acquisitions and business development for Kogers Agshama and then for Intu. These are essentially the largest Israeli crowdfunding platforms. And more recently, I've opened my own umbrella, Leviathan Private Equity Groups, raising capital or sourcing deals rather for those two crowdfunders and additional other LPs that I represent.
That's great. So why don't you describe how that business works and what are you doing when you're advising? Are you just brokering deals? Are you helping negotiate the structure? What is all the services that you're providing to your family of funds?
Mm-hmm. So essentially, for those funds, I source deals and introduce, sponsors for long-term relationship. The idea is to these funds, those two funds specifically are based in Israel, and they benefit from someone like me who has a Rolodex of over 2,000 sponsors, owners, operators, developers who are looking for programmatic joint venture investments. So my job, essentially, my role is understanding their investment criteria and the type of sponsors and deals that they look for, and I basically put the hat of a director of acquisition for them and go out there and source relationships and deals. I do the initial review of the sponsor and the deal. And negotiate initial terms, and then present the opportunities to the fund and take it through the whole process through investment committee, joint venture agreement until the deal is closed, basically.
That's great. So what are some of the core strategies of the groups you represent?
Mm-hmm. So the most apparent strategy of the groups I represent. Acquisitions of existing assets with existing cash on cash. So typically, 3-4% cash on cash year one. They underwrite, under normal circumstances, they're happy to underwrite to 5 years equity hold. More comfortable with a 3 years hold. Exit being refinance or buyout, doesn't have to be disposition. They underwrite to north of mid-teens IRR. And the idea is, of course, to move towards more core plus, lower returns, and maybe longer hold and higher cash on cash. With the understanding that current market, notwithstanding, equity size checks have been in the past. I mean, with Agshama, we've done about 7 deals of $10 million. We've done a lot of $3 million deals. With Intu, we've done mainly $3 million deals on the equity side. And Agshama now is doing $3 million deals. Intu is more concentrating on existing sponsors right now. And the future, I believe, both. I know Agshama is definitely looking to increase the check size and go back to being as active and we're going to be seeing larger checks as the market comes back to correct itself. But the future is unknown. There are other groups out there. There are groups that are more institutional, writing bigger checks, 7, 8 million, 10 million, and $30 million checks on the equity side. They are looking more for higher cash on cash, longer term hold. So 7 years hold for north of 7-8% cash on cash. For obviously low teens IRR. There are other funds out there. I have a fund who's concentrating on ground ups in Texas, multifamily only in Texas ground ups. I have an Israeli fund that's focused on healthcare. Their DNA is based on they are the largest senior houses and nursing homes owner in Israel, and they have an investment arm I invest in multifamily and healthcare assets here in the US, which I represent as well. I do some triple net leasebacks with another fund. So there are a lot of different strategies there. But namely, I would say, everyone is looking for cash flow. The question is, how do you get it? Multifamily is very competitive. So how do we, so one thing I've done, I opened for other funds, medical office, triple net leasebacks, other strategies that are kind of, under the radar for all the big multifamily players.
Makes a lot of sense. One thing you said earlier that was interesting was how hold periods are changing or strategies are changing based on the current environment. So I've been hearing a lot of people, due to the uncertainties of the current market, take less risk and lower their hold period. But you mentioned one of your funds is actually looking to shorten their hold period due to what's happening. So can you explain what that thought process is?
Yeah, I think the thought process is to search for opportunistic special situations, buying low, fix it up quickly, and not stay for the long haul because it's very uncertain. I think, if you ask me, that's very risky, but historically, the funds that are thinking about these strategies are, have investors that are opportunistic, that are looking for higher returns. In my mind, it's safer to go for higher cash flow and longer term, because then you have a longer breath to withstand the cycles of the market. But it really depends who are your investor base. Israeli small investors are used to, they don't feel comfortable for long haul because of the uncertainty and liquidity. They feel like, if they don't necessarily, a lot of them do not necessarily understand the risk reward concept. For them, a deal that generates the projected IRR 22% has to be better than 16, right? Where we all know that 16 in your pocket is better than 22 on a tree. So
I like that.
Yeah. So it really depends who are the investor base of each of those things.
That definitely makes sense. And that's interesting because you and I think about it where a longer hold is actually less risk, right? But for some other investors, they might think of a long hold where they're tying up capital for that period of time as increasing risk rather than decreasing risk.
Exactly right.
So going to the larger check you mentioned, or larger LP investor that is looking for 7-8% cash on cash, low to mid teens total returns, longer hold period. I think for some people listening, they might say, wow, those returns, they seem achievable. I can maybe find a deal out there. So what are the other characteristics of the deal that might disqualify a lot of deals? Because just on the surface, those return hurdles may not seem that high, but if you put on other criteria, it might start discounting a lot of opportunities.
Yeah, I think first of all, it's not easy to find a deal that generates cash on cash of 8-9% year one. That's not so easy, and then supports it with a very strong asset and market and that has an outlook, especially now, for long-term hold. The second qualifier is the strength of the sponsor. This fund, particularly, they write checks between their minimum is 7-8 million. They don't really have a maximum, but their sweet spot is $20-30 million of equity check. Obviously the sponsors have to have substantial experience in the market. Also, the other thing is that they subrogate the cash on cash up to 8-9% to them. So the sponsor has to be strong enough in order to be able to operate until until the asset generates enough cash for them to pay the bills, other than asset management, property management fees. So that is the challenge. Is really the sponsor ability to support the deal rather than finding the deal itself. But obviously, someone who writes those kind of checks on programmatic basis could facilitate a very quick growth for those sponsors who are able to support those deals.
Nice. I like this. This lets us segue into a topic about what are investors rather looking for from, let's say, a newer sponsor, right? They're obviously looking to build these programmatic relationships, and at the same time, they're looking for qualified, experienced sponsors. So how do you get in the sweet spot where they're not too established and potentially looking at other sources, but still not to new where it's a risk?
That is an excellent question, and that has been our challenge in the last few years. Is there's a window of opportunity. There's a very narrow window of opportunity for the funds that I represent, at least. Catching those sponsors at the window where they just outgrown their friends and family, and they need a programmatic investor, but they're not big enough in order to say, oh, $3, $4, $5 million check is just too small for me. So those funds like those, experienced sponsors, and I have one sponsor based in Indianapolis that they own and manage 20,000 units in that market. And they have 300 employees. They're vertically integrated. I was able to transact with them. I was very lucky to. But essentially, do they need my funds? They don't really need my funds. I mean, they raise without it. It's just for them, it's another source of equity. So the challenge is exactly that, is to find that window of opportunity of those sponsors that, they've done 3, 4 deals, 5 deals. Maybe they return equity to their investors on 1 or 2 deals. They have a team in place, but they're not big enough that they can raise equity on each and every deal from their existing investor base. That is challenging. Yeah.
That makes sense. That's great. So what about, let's go deeper into, you mentioned a couple criteria, but let's go deeper into sponsor evaluation and, real criteria.
Okay. So, it depends on the fund, but most of the funds that I work with, we look for sponsors that have enough experience in this particular sub-market that the opportunity exists. For example, if you brought me today an investment in Baytown, Houston, for example, we would be looking to see what's your experience in Houston. Maybe not in Baytown, but in similar markets in Baytown. And if you are buying 220 units, multifamily assets, vintage 70s, we want to see that you dealt with that kind of product around that market. And if you're investing about $3,000 a unit in the interior, $800,000 in the exterior, and and you're buying an asset with 70% occupancy or 90% occupancy, you want to see, that you have done that kind of value, that you have executed that kind of value add strategy several times successfully. So typically these funds are not adventurous. They're not going to say, oh, wow, Rob is a genius. He's starting out. Let's put our money on him and let him run and do his thing. Oh, the light turned off here. There's a second. There you go. These funds are relying, because they sit outside the international funds, they look for someone local with boots on the ground, and they're relying on their expertise to run the day-to-day and their expertise in the sub-market and product type. They're passive on the day-to-day, so they don't need another one who is sitting in New York and has a third-party property management to do all the work in Texas, for example. They want someone who gets their hand dirty, typically, with the exception, of course, of economies of scale. I mean, if someone has 20,000 units all over the place and they're sitting, in New York, and they're great managers and they have a team that can travel and, and they've executed and have the track record to support it, then I think it's easy. It's an easy sell. But there's a range there. There are funds, for example, into require at least 1,000 units in the submarket, or market, I would say, not necessarily submarket. They require a portfolio value of at least $100 million, and at least 7, 8 people on payroll. Corporate like Shamat, they do not have this criteria specifically, but they want to see several full cycles of product type. They want to see some experience in the market. It's not rigidly defined. They have more experience in terms of years. So when they started, they've done deals, with a father and a son, with no operation, no track record, and just felt comfortable with them and, invested. And some of them were successful, some of them were less successful. So they have a lot of scars from bad decisions in 2008, 2009, and that's how their criteria evolved. I know Into, for example, they had one sponsor who was 42 years old, a single operator, one-man show, was amazing developer, went to sleep one night, never woke up. So since then, they started requiring life insurance.
Wow.
So, so those criteria has evolved. My father used to say every stop sign in my neighborhood was written with blood. It's kind of the same thing, right? Also, aviation safety, a lot of the regulations were written with blood. Same thing with equity, I think, because equity is very vulnerable, unlike debt. Debt, you have 70% leverage. If something goes wrong, the bank steps in, takes the asset, gets their money back, no harm done. Equity, if something goes wrong, the sponsor doesn't operate, we own a problem. And that's why the sponsor is the one who gets us out of trouble. The sponsor is the one who makes the deal work or not.
Absolutely. So before we go into the details of joint venture structure, I want you to bring up the mezzanine bonds, if you will, that you were mentioning before we started recording.
Mm-hmm. Yeah, so this is something that I'm exploring. We had several structures. Essentially, the joint venture equity is expensive, and it's also it's not easy for especially younger sponsors to raise funds from LPs. I mean, and if you by the time you find the competitive opportunities, you may not have enough time to move on it, wait for the LP, yes or no, maybe this committee, that committee. Then they don't approve. Sometimes they don't get even approved by agency debt. I mean, it's not easy. So the idea is to issue mezzanine bonds that are backed by sponsor guarantee and second lien on the property level and first lien on the SPV level. So issuing those bonds outside the US and then negotiating with the sponsor what they're able to pay on quarterly basis. The challenge, it has to be a sponsor that has a balance sheet in order to support that, and also the ability to pay the coupon even before acquisition. Because once the funds are being raised, the clock starts ticking. The investors are expecting their quarterly payment. So, for example, raising $10 million tranche gives you, a fund that you can go out there and use as equity on multiple investments. So essentially, you can use anywhere from $500,000 to $5 million per deal from that fund under certain parameters. For example, not more than 70% leverage, not lower than 80% occupancy, and so forth. And then we could kind of adjust how fast we market those bonds to your acquisition and renovation pace. So, you buy the first asset, you renovate, you stabilize it, you have enough cash flow to pay the coupon on the amount that you borrowed. Let's say you borrowed $1 million, $2 million, you renovate, you stabilize, you can pay the coupon. Now you're telling me, okay, go for the next tranche. I go market the next bond, the next tranche of $1, $2, $3 million. All you need to pay is the coupon. And then you have, equity that you can go out there and buy. That is essentially the idea. This is something that a product that I'm building, that once it's ready, I'm going to be able to go out there and market it as a product that I could sell essentially to sponsors. So if you, Rob, told me that, hey, I could use a $10 million mezzanine fund for myself, then we could design a product for that and issue those bonds, then market it for you, and then essentially raise the funds. And as soon as the funds are being raised, you're able to borrow them immediately and start paying the coupon and do what you do, and then pay them back as soon as it would be a 5-year bond. But your strategy should be, value add, essentially paying them back within 18 to 24 months.
Right. Great. Thanks for sharing that. So You said joint venture equity is expensive. Let's dive in and talk about, typical preferred returns that your funds have, and the structures, equity commitments, and obviously the promotes.
Yeah. So when I say it's expensive, it depends on how you look at it, right? I mean, from some, expensive or cheap is very subjective. So typically preferred return rate is anywhere from 8 to 10%, which is, I don't think that's expensive, right? And then promotes level depends on the deal and the fund, but, typical promote is, 15 to 30, 35% promote up to mid-teens to north of mid-teens IRR. And then I've seen, 30, 35 promotes thereafter up to another hurdle, and 40 to 50% promote thereafter. I've seen structures in which the initial promote 30% up to an IRR, and then we flip it. So then the sponsor takes 70% on the back end above that IRR. Essentially, most LPs that I know, the structure incentivizes sponsors to provide a minimum IRR to the investors, and then incentivizes them to reach that IRR quickly in order to get to the juicy promote. So it protects the funds and incentivizes the sponsor to perform. It's not a 50-50 structure usually, because on a 50-50 structure, the sponsor has less incentive to reach a specific IRR hurdle. When I say 50, it's not 50-50 from the get-go, but essentially those structures are designed to reach the IRR, but overall, if the deal works, the sponsor ends up making either 50% or more than 50% of the profits, the total profits of the deal, for anywhere from 10 to 20% of the equity, and obviously doing the work, personal guarantee, and all that kind of stuff. And then usually those funds charge a fee to the deal. The two largest funds, Into and Agshama, they charge 5% equity fee charged to the deal. Other funds usually charge much less, 2 to 3%. But Into and Agshama historically provide a firm commitment to the equity. And they had at least historically, they had a lot of muscle raising a lot of funds. I mean, Agshama has done over $1 billion of equity across 300 deals, and it's a big machine to feed, and that's why they charge those 5%. And Into also, I mean, essentially the same kind of deal. Other funds charge less, but they may not be there for you every deal that you want them to be. And that is the challenge. Once you negotiate JV agreement and you find that LP who can transact with you, you really want to believe that when you find the kind of deal that they want to do, that they're going to have the appetite to be there for you. And I think a lot of it is timing. With Agshama, we had one sponsor that has done 30 deals with them in 4 years. But it's also about timing, where that fund is in the cycle, right? Right now, during Corona time, I don't know if that sponsor came today, if they would say, wow, we're raising funds so quickly now, we can really do another deal right now. I just don't think so. It's about timing. It's riding the wave when and it's a lot of luck.
So got a couple questions for you. So you mentioned, one of the things you mentioned was certainty of closing, right? And I know personally that Agshama has a very unique timeline and process in terms of issuing the LOI. So, and your other funds might have similar strategies as well. So can you walk through that typical process of, being presented the deal, talk about how is it best to present the deal to you and your funds, and then that process from the beginning to the actual closing?
Yeah. So first of all, the team at Agshama and Into usually is very quick with the initial review. Typically we look at the Excel sheet, the projections from the sponsor. The OM we take a quick glance at. I mean, we really want to hear the story from the sponsor, so we want to feel that we have a partner. So we essentially, the first question is, what's the contract status, closing timeline to understand if we have that time or ability to close on time or get an extension if we need to, or if the sponsor has the ability to close on their own equity and give us the ability to finish our process to recap their equity. And that's actually, from our perspective, is the ideal scenario. And we have done it a lot of times. Sponsors that have the ability to bridge equity based on our firm commitment, that's the easiest thing to do it, because it takes the pressure off the sponsor of, are we going to be able to make it. On the other hand, those funds, when they issue a firm commitment, they have a good track record of showing up on time. So the key is to show the deal early enough that everybody has enough time to work, with the understanding that until the deal is under contract, it would be tough to get everybody on the funds team at the table. So the idea is to get them engaged early enough and interested enough, and keep them updated along the way, and to kind of check the pulse on their level of interest as things, get to maturity. A lot of times I get, huge packages with rentals, historicals. This is great. And nobody's going to look at it until we know there's a deal. The most important thing for us usually to look is really the sponsor's underwriting and the comps. Basically, what we look for is what is the seller's investment rationale, who they are. Is it a moms and pop shop? Is it a REIT? How long they've held the asset? And what's the disposition rationale? How has the sponsor sourced the deal? To understand the story. Why is the seller selling it? What's the story? Is there a catch there? Is it an off-market deal? What's the story? Is it a marketed deal? What's the cap rate? What's the acquisition basis? Is it a good deal? Just a regular deal? And then obviously, what's the sponsor's renovation and value add strategy and exit scenarios? And what we look for is very basic things: cash on cash year one. And then we look at what happens if the sponsor doesn't touch the asset from acquisition. Are we able to pay the debt? So DCSR based on T12. So if you borrowed today, we take T12 and we see that we see if we can pay the debt, or if not, what's the gap? What's your renovation schedule, renovation strategy, and then the rents, right? How much are the rents today? How much you're increasing it? And what is the current market? What does the current market supports? So if, one bedroom in your asset is $560 today, and you intend to renovate and increase it by $125, we want to see several assets in your submarket of similar vintage that have already renovated and that are achieving that rate. A lot of sponsors are overly optimistic, everyone is optimistic in our business, because we wouldn't be in business if we were pessimistic, right? But we want to make sure that our optimism is based not only on our sheer genius and talent, but also about our based on our hard work gathering data to support our thesis. So we look for renovated comps that support the exit scenarios, and we look for renovated sales comps, meaning we typically look at, if you're exiting at 5.5 cap at $170,000 a door after 3 years, you want to see 3 or 4 transactions in your submarket that have already transacted at that price per door cap rate, and hopefully around that PSF, that you're not reinventing the wheel in your submarket. And in Texas, we hear a lot of, well, it's a non-disclosure state, it's very difficult to find data, or there's not much of that product type in that submarket. And a lot of those stories are true. Sometimes the opportunity is in the lack of data. I had a deal in Galveston, right? How many multifamily assets there are in Galveston? None. That's the opportunity. The challenge is, with those funds, they don't necessarily jump on those opportunities. They rather take a more conservative stance and rely on existing data, which sometimes makes it difficult, because if there's a lot of existing data, that means there are a lot of also existing players or looking for. So that is the challenge, but that is the reality also that we live in. So comps is the king. Sponsor track record is the king. And when I say track record, it's also important to understand a lot of people who come from, who used to be executives in very large companies and have done a lot. So they have amazing track record. They've done thousands and thousands of units of value add as executives, and nobody can take that away from them, and that means a lot. But for those funds, that is their education. It's not their track record. They want to see sponsor track record as GP of record, as a borrower, as an executioner on their own account, and that's also important to understand. I've done, on behalf of the fund, thousands and thousands of units, millions and millions of dollars. But, if you look at my track record as a multifamily operator, and I went tomorrow to one of those funds who know me very well, and I said, hey, would you invest me with $3 million on a 220 unit multifamily assets? They will look at me like I fell from the sky, right? Because the track record, my track record is in the multifamily arena is not as a sponsor. And that's important to distinguish. Because a lot of people claim track record as different things.
Yeah, a lot of great stuff there for sure. I want to go back to the part where you mentioned the structure with the preferred return and then getting into the promotes as a way to really, number one, protect the funds, and then two, incentivize the sponsor to outperform and return capital, right? Because the quicker they monetize and sell the deal or pay off the LPs, the more they get into their promote. So how is that structure changed for funds that you work with that are looking for the longer term hold and more of a cash on cash focused deal?
Mm-hmm. So the longer term deal, the longer term hold fund, typically you don't distribute cash and cash pari passu. Basically, they take all the cash and cash up to 8-9%, and anything above it, they start the waterfall starts. The clock starts ticking, or everything starts above that cash on cash. Then they start distributing profits. And the promotes also from there starts at 30% up to an IRR, and then 50% above it, or even 50-50 right above it. Because once they achieve the 9% cash on cash, sometimes they're happy to do 50-50. The other funds, a lot of times they're happy to divide cash flow pari passu, first rate pari passu with the sponsor equity. So essentially all equity is treated the same, depending on the situation. Sometimes they would say, well, the sponsor is young, he has, we're not 100% comfortable with the track record, but we really believe in them and so forth. But, we want to have an extra layer of protection. So we would ask for a full priority on our equity, sometimes full priority on the equity and preferred return. So that's how it's levers they pull.
Are they looking for an 80-20 equity contribution on that, so that the 20% sponsor equity is subordinate to their 80% LP equity, and that LP equity gets their 8-9% preferred before any cash flow goes to this 20% tranche?
Exactly right. And a lot of times, if there are other investors in the deal, they may ask for full priority on other investors, which I know it's challenging a lot of times, depending on who are the other investors. Sometimes you don't even know who they are going to be. You just know that you're going to syndicate somehow, and then how you're going to syndicate if you're giving someone else priority. So it depends. And we've done deals with full priority. We've done deal with priority only on the return of equity, but only in front of the sponsor's equity, not at the sponsor. So it's a matter of negotiation. But basically, the more flexibility the sponsor is able to offer, the stronger the deal is going to be, especially on the first deal with the fund. And then, on repeat deals, you're able to say, so on the first deal with the 80-20, you got full priority on the preferred. This time, let's improve the terms. We'll do 15-85. I'll give you only on my equity, not the preferred, and so forth. So you can improve terms from one deal to another until reaching 90-10 with no priority. once you perform and you've proven yourself that most importantly, I mean, it's not about, not having any negative instances or negative occurrences in your project. There's always something, right? I mean, maybe you're a little late increasing occupancy. Maybe something happened in the asset next door, had a shooting and your occupancy dropped. I mean, I'm saying from experience. I mean, we had one operator, there was a shooting in the asset, occupancy dropped. We had 2 hurricanes in Florida, things like that. We had Harvey in Houston. But I think from those catastrophe occurrences, it's how the sponsor handles themselves. As long as they, if the fund is the first people, they pick up the phone and say, "Hey, I have a problem. This is what I'm doing to mitigate it. I'm at the asset. I woke up from bed. I drove in the middle of the night to manage this disaster, flood, hurricane, whatever it is. And this is what we're doing. We're reaching out to the insurance, blah, blah, blah." They're communicating, they're sending reports, they're showing the fund exactly what's happening. They look them in the eye and tell them things the way it is. Then it's not necessarily the outcome as much as how they manage it. And that's important to understand. When you pitch a deal to LP, you want to paint a rosy picture, obviously. But even during the underwriting, I had a sponsor now on a deal that we're doing. They asked him for a report on what's going on in the surrounding area during COVID. And they provided very thorough reports that didn't necessarily paint a very rosy picture. But obviously the asset itself is still painting a good picture. But the fact that they provided all the information without trying to paint it, I mean, that spoke louder than anything else to the fund. They felt very comfortable that they'll say things the way it is rather than what they want to hear. And that is very important for sponsors to understand.
That's great. And I'm glad you brought that topic up because I think that's an important topic to cover, which is reporting. But before we do, I want to go back to what you mentioned earlier with the senior subordinate structure and how it can be based on cash flows as well as capital events. And I think I just want to make that distinction for people who may not fully understand what that means, where there can be priority on cash flow basis. So as the property is generating cash flow, the first X% cash flow goes to one investor versus the other. But there's also priority upon a capital event where a sale or a refi happens and first money out is going to be the LP. And if there's any equity remaining, then the sponsor can receive their return of capital, which obviously is more risk, but an interesting distinction where, you might be negotiating a structure where you're on equal footing as far as getting your money out of the deal upon a sale. But in terms of cash flow, there's a senior subordinate structure, which is obviously better than having you fully subordinated in the structure.
Correct. Yeah, and it varies from, you can negotiate anything. I mean, there's a wide range of options to negotiate, as you mentioned.
Yeah. So let's dive into reporting real quick. So you mentioned it's important that you share the good and the bad. It's important that you are thorough and that you communicate often. So what does your ideal reporting look like from a sponsor?
Yeah, so first of all, to be honest, I mean, this is not my, my expertise. I mean, usually I take the deal to closing and, my colleagues, the asset managers in the fund manage the reporting. So I don't know what it entails. I know they have a whole, list of checklists of standard reporting that they require in terms of performance of the asset and, bank accounts of the LLC. The LP typically wants to have full access to the LLC bank accounts, and then they review the statements, the operating statements of the asset. But most importantly, is reporting of overage expenses if they occur. I mean, the JV agreement stipulates usually a range, and that's also part of the JV negotiations of what unexpected expenses or overage is the sponsor allowed to make without the agreement of the LP, and what expenses or overages they need to get the LP agreement. And that is an important part of the negotiation. Also, sorry for going back to it, but during the underwriting, the LP also fills out the sponsor understanding of their costs. You know, when you ask a sponsor on the CapEx and they show and they remember exactly how much they're paying for cabinets, fixtures, handles, every part of their CapEx budget, that means they've done it many times and they know exactly their cost basis, and there's less room for surprises. And that helps later the negotiation with overage permissions from the LP. And going back to the reporting, when something happens, the LP wants to be the first one to hear. So if there's an unexpected, tax liability, they're going to approve it because they have no choice, but they want to hear about it first. They don't want to hear about it that there was an expenditure that they already incurred without their agreement. It looks different when somebody gives you a call and gets a permission to spend money rather than, oh, what was that? Oh, well, I had this unexpected expense. I'm sorry, I didn't tell you. It looks different. And that is really the bottom line. Because as far as what you need to report, you're going to get a checklist from the LP very early on before, you can ask during the negotiation, during the JV agreement negotiation, you can ask for a checklist to understand what you're getting into in terms of reporting.
Nice. Very good. Well, thank you so much for coming on the show. Thanks for a great discussion. Go ahead and, let all the listeners who might be sponsors know where they can find out more about you and connect with you further.
Sure. So first of all, thank you for having me on the show. Always happy to chat with you, whether on the show or off the show. I can be reached at my email, which is my first name, Roded, RODED, at Leviathan, LEVIATHANPEG.com. PEG stands for Private Equity Group. So LeviathanPrivateEquityGroups.com. The website is not on yet, but everything else is. Which is most important, and I'm happy to stay in touch with you and all your colleagues. Feel free to reach out with any questions. If anyone wants to run anything by me, I'm always happy to chat, including you, of course.
Thank you very much.